So thank you very much for attending today's weekly market analysis webinar. Had some interesting moves last week. Big jump higher in the euro. We'll cover that straight off the bat. Some gold and oil doing very well at the moment. Stock market's getting a bit more spicy if you're trading the DAX, also the FTSE to some extent. US stocks still very much in a firm uptrend, although the Nasdaq and the US Tech 100 potentially presenting a bit of an opportunity here. We had another signs of the beginnings of another tech wreck. So we're going to talk about all of those things. Obviously, if you have any questions relating to those or anything else, just let me know anytime, and I'm happy to discuss that with you. So here's just some of the kind of themes that I think are worth covering this week. I think we're all pretty familiar with the major themes, although definitely a bit of a sense at the moment. You know, I think you can attribute some of the weakness in the US dollar that we're seeing to Donald Trump and the lack of progress that he's made on his own policies. You know, there was a little bit of progress last week in that the healthcare bill was doing well, but obviously John McCain scuppered that a bit. So still Trump having a bit of a tough time, getting bogged down in healthcare, not able to get through the tax cuts and things. So I think, you know, should there be signs that Donald Trump is more on his agenda, then that will be very much something to look out for. And it won't happen overnight, but that could be the point in which the dollar starts gaining strength again. Obviously, the Fed didn't do anything last week, so this week we've got the Bank of England and the RBA. The Fed were, just as a quick recap, the Fed were quite dovish, I suppose you could say. They made a slight tweak to the language with referring to inflation, and so you know, the interpretation being that maybe September's not on, or maybe indeed December's not on, but it does look like they're still determined to start shrinking the balance sheet. So that's quantitative tightening, and maybe goes to explain why, you know, some of the markets out there getting shaken up a little bit. We've still got non-farm payrolls on Friday. We've got another webinar for that live during the event as well, so attend that if you can. Bank of England meetings on Thursday, and then obviously we've got lots of earnings coming out still, and so, you know, I think those earnings have been a big catalyst for why generally the stock market's been doing well, but also why maybe some areas of the stock market are underperforming. But I'm not going to spend too long going through all the fundamental ideas. If you want a bit more of a flavor, please check out the week ahead video. For now, I'm going to switch gears to the charts. And we'll start with that euro chart. And so, obviously, benefit of hindsight always, but looking back, it's been a fairly beautiful trend. You don't get these opportunities that often. When you think of the base down here was at 105, and here we find ourselves, you know, 1,200 pips later at 1,700. You know, it's been a pretty nice run for the euro. Now the trouble at this point, obviously, is now that we see that clear trend behind us, the question is, does it continue? You know, I don't have a crystal ball, so I don't know. But we've hit the 117 level, which was the peak here, which I would say is probably not the important top of this range. See how we paused down here at 114.50, and I was talking about 114.50 as a significant level at the time. That's kind of where most of these peaks were made during this range-bound period. And so we had a couple of false breakouts. The 117 or just there above was one of the more prominent attempts at a breakout. So now we're at that level. But you can see the price action has been a lot more steady. There's no signs of a long wick, you know, where the price action pushes out of the range and then closes down dramatically lower as it did on these two occasions. You know, nothing like that. So this move higher looks a lot more viable than those, you know, those two there. And so to my mind, the odds are that we're pretty much bottoming here in the euro. The difficulty is that that's becoming a bit of a consensus opinion now. So whereas at the start of the year, a lot of the investment banks were calling for a parity in the euro, now they're calling for 120. So, at some point the sentiment's going to get a bit too positive and we're going to run out of buyers essentially. We're probably not quite there yet. There's no real evidence of a top, to my mind. There's no trying to make a high, retesting the high, failing, anything like that going on this weekly chart. So at the moment the trend just looks strong. One thing that I'll use to gauge the trend and potential entry points is both a combination of the moving averages and the RSI. So if you can see at the moment, generally, you can see we've pretty much been in territory where we're holding above the 50 level. So the 50 level being the midpoint of the RSI. And so whenever we've got close to the 50, or indeed dipped below it a couple of times, it's not an exact science, these have actually proven to be the best buying opportunities that we've had within this trend. And then to a lesser extent, you see that when we get dips down to the 60 level, typically from an overbought area, that 60 is considered slightly oversold within the concept, within the context of an uptrend. So we've seen that recently as well here. These dips down to the 60 level have resulted in decent dip buying opportunities. Now we're pretty overbought again, and so certainly if can the market extend from these overbought levels? We're at the 70 in the RSI. Can we just pop up to 119 without a retracement? Of course we can, but it's just when you buy at such overbought levels, you are putting yourself at risk of being caught out. Even if you're getting the direction right, you get caught out with a bigger correction, which can be frustrating. So at this point, I'm probably waiting for another opportunity down near the 60 level in the RSI, which would probably come in around the 115.50 level, and probably in and around that 20-day moving average, depending on how quickly it happens. Now, given that we have hit that 117 level, which is potentially important, maybe that will be enough for this correction to actually extend further beyond that. But I still think that would be a likely area to get involved. Depends how bullish you are on this situation. Again, we've been going for a while in this trend, but maybe it just takes a little dip down to 117 before we pop up again. It's just if you do put if you do enter at 117, where do you put your stop? One option is below this low here, but you could still just get a pullback to the 20-day moving average and you'd be stopped out on the trade. So it's a matter of weighing up the opportunity, the clear trend, which makes it easier to choose a direction, versus how far we're into the trend we are and the likelihood of pullbacks. One data note is that we had European CPI come in at expectations at 1.3%. That's unchanged. So obviously, if we'd had stronger inflation, that would have been more of an impetus for higher euro, but we haven't had that really. Moving on to the British pound. Quite a different scenario with the pound, as I mentioned in a snapshot video last week. Quite a different scenario between the pound against the euro and the pound against the dollar. Against the dollar, it's looking strong because the dollar's looking weak against everything. Basically, I've just read, I think, that over this year the dollar's down against 17 different currency pairs. So uniform dollar weakness, really. Here on this pound chart, if I pull out again to the weekly, here we've made a breakout. We pulled back the next week, but we jumped straight up again. So this was an inside. This was almost an inside bar here, but it was a small correction. It corrected about 50% of that bullish engulfing candle, and then we closed higher again. Now, this hasn't been a gigantic breakout, but to me, we're back above this previous high again. It looks overall positive, and I'm still, I'm still looking for this market to move higher. It looks a bit choppier on the daily chart. It's a little bit harder to gauge, but again, keep in mind the fact that we're above the 50 on the RSI, we're well above the 20 period moving average on the daily chart. So really, if you're following the trend, you know, the trend is higher at the moment, so it's just about picking your spot. A dip down to 130 would certainly be a decent opportunity, but just keep in mind this is the high that we've taken out. So if we do get any dips down to that high, which is basically 130.50, that again might be an opportunity in itself. You know, the risk is that at the moment we've come down to 131, and we're moving higher again off that level, so we may even not get another 50 pips lower. Given the general bullish outlook for this pair, we may just push on from here. Obviously, the big event risk this week is the Bank of England. To me, obviously, there's lots of subtleties with this and lots of potential variables. You know, one thing that could really shake things up is if we get another dissenter. At the moment, the voting's 5-3. The new deputy governor has just come on board. He seems fairly dovish, fairly in line with Mark Carney. So I don't think there's going to be a situation in which we have an equal or larger number of hawks than doves. So the situation could change, certainly worth watching, but I think more simplistically, it's going to be, in terms of market reaction, it's probably going to be the Bank of England trying to talk down the pound, saying that they're not going to hike rates anytime soon. You know, there's uncertainty around Brexit, around consumer inflation outstripping wages. And so it's just a matter of whether the market takes that at face value, or indeed just look through the rhetoric and think, well, actually, still the UK economy is doing fine, and we don't deserve such loose monetary policy conditions. And that's kind of what's happening in, you know, it's across the board. It's the euro as well. You know, there's inflation. There's no signs of deflation. You know, we don't need this kind of extreme quantitative easing conditions that we're in at the moment. So does the market look through what the central banks are saying, or do they take it at face value? If they take it at face value, obviously that's negative pound. You know, if they look through it, you know, that to me is positive pound. And we, you know, I think there's a good chance of the latter, just because that's the direction of the trend at the moment. Had a few questions coming through. Mike, I hope you can hear me. You said that right at the start of the webinar, so I'm assuming you can hear me at this point. Have not had any other complaints. It is Apple's earnings tomorrow. Just had a comment on that from Ishmael. You know, certainly Apple being the largest market cap company in the world, obviously it's the most widely watched earnings release. You know, I think there's room for disappointment here with Apple, because at the end of the day, the way everyone's thinking about Apple now is that people are holding back their iPhone purchases until the iPhone 8. So I think if Apple comes in ahead of expectations, obviously great, you know, the stock can likely move forward. If it misses expectations, it's not the end of the world, because we're looking for a big quarter, you know, once the iPhone 8's released. Because for Apple, even though they're gaining traction in other areas, it's obviously still all about the iPhone. And you know, it's understandable that in the quarter before the release of a new model, sales start to slack off a little bit. So you know, I can pull up the chart of Apple quickly, make some sense in terms of the order, since I'm about to move into the indices after that. Hope no one else minds. So we had another sell-off in the Nasdaq last week, a bit of a dip in the Apple shares as well. You know, in the great scheme of things, obviously Apple looking very bullish, but it's certainly at the center of the tech market. And if that question I had at the start, is there another tech wreck coming, if the answer to that is true, then we can see some more weakness in Apple. And as I said, you know, I think that Apple can come out on the other side and still probably make higher highs when the iPhone 8 comes out and the quarterly results are better. But if that it can still decline before then. So we had a bit of a reversal last week before we got to the previous highs. So signs of a top. To me, this is still an uptrend, and it'd be risky to sell going into Apple earnings. But I can certainly see a case for it, because we basically failed at the 155 level again, 2 times essentially, leading into the results. So, and I guess the other indication would be that we've had Facebook results were very good, but there are some signs from other companies that actually ad revenues are coming off a bit. So maybe that's a pause for thought as well. But the other thing to mention, I suppose, is for those who are just trading the indices, if Apple's results are bad, that's generally going to be a bad thing for the Wall Street 30 and for the US Tech 100. So definitely worth watching those results if you're trading either of those indices. And so if I show you the US Tech 100 there, here's it's quite an interesting development really, because it is a higher high. And to all intents and purposes, the Nasdaq's broken out of this previous range. But it pushed high for a few days and then obviously collapsed and then closed back above the range. So, maybe just flushing out some of the weak hands in order to move higher. To me, the way I'd be looking at this opportunity is 2 long wicks there. If we get a breakdown through this low, which it's quite a pivotal one, because that was the high there at 5,850, came back, touched it, failed again to get through it, and now we're pushing higher again. If we dip below there, to my mind, that suggests this is a false breakout, and sellers have had enough strength to push through a lot of buy orders through there. And to me, that probably means we come down and test somewhere in the vicinity of 5,650, or maybe even the lows here, which was around 5,550. Also worth bearing in mind this, the fact that there's some pretty strong negative divergence in the RSI here. So we pushed up to this high, we had a big reversal engulfing candlestick here at the same time that the RSI failed to even get into overbought territory, was definitely well below the 2 previous peaks. So always risky looking for sell opportunities in the indices, but we're potentially looking at one here. I think if you're selling up here, obviously you're at a better price, but there's not really as much evidence that the market's going to roll over. If we get crashing through these lows down here, yeah, of course it's a lower price, but a bit more evidence that the sell-off is gaining steam. Switching back to the UK 100, being a bit choppy, to be honest, recently. Put that back to how it was. Zoom out a little bit. So again, I don't know if any of you ever use the RSI, but you can modify these indicators, and what you can actually do here. So you've got the lines, change the colors, you can change the levels too. You can just add in the 50 level, and you can sort of see that when we're above the 50 at the RSI, we tend also to be above the 20-day moving average. It's an uptrending period, and then the last few occasions where we've come and tested close to the 200-day moving average has also been when we were testing the oversold levels in the RSI. So minor levels of oversold tend to be nice dips. Larger levels of oversold tend to be correlating with these bigger dips. We haven't quite got there yet. To my mind, we pushed back above the 50 level, but we didn't hold above it for very long, and now we're drifting lower again. So it sort of seems like maybe we need to make another leg lower before we can push higher again and come into that oversold 30, 200-day moving average area again to be a slightly better opportunity going along the market. But let's see how we develop here. If we can push back above the 50 and then maybe provide some sort of high to break through, that may be all that's needed. How are we doing for times? Okay. Rambling on a little bit today. Yeah, Wall Street's certainly the firmest of the markets out there. you know, with the benefit of hindsight, obviously every time we've had some dip near the 20-day moving average, it's been a pretty decent buying opportunity. Now we're well up there. We're into overbought territory above the 70 level, and we're obviously pushing into record highs. Difficult to go long the market here. Probably missed the boat, to be honest. Even if we do push high for another day or two, bit high risk. Probably want to wait for another pullback towards perhaps the, just look at the round numbers. 21,800, you know, is a bit too close. 21,700 perhaps might be a better bet. It's almost difficult to trade these indices because they're so so firm. It's difficult to actually pinpoint a decent pullback area. But if you have something you can consistently look back at and see as a moving area of support, like the 20-day moving average, like the 60 or the 50 levels on the RSI, gives you a little bit of a sort of measuring stick, if you like, for where to look for your entries. Germany 30, as I mentioned, certainly the more interesting index at the moment. We're having quite a sell-off. I think this largely explained by the fact the euro's at 117. You know, a lot of exporters in Germany, and then just naturally they're going to be making less money with the euro. Not only the highest in 2 years, but also looking very strong. As we mentioned before, this breakout looks like it has some resilience, and investors reacting to that in German company shares. And we do still have the German election later in the year. Still thought to be pretty much a guaranteed Merkel win, but you know, who knows? There is that uncertainty still. You know, we're into August now. The elections, is it late September or October? It's one of the two, but we're getting close anyway, so you have to start factoring it into your investment decisions. So maybe go some way to explain the weakness in the DAX. That said, I still wouldn't be aggressively short. You know, it's still a stock market which is part of the overall bull market. So we've hit the 1220. Well, we've got as far as basically 12,100 is where we found this latest low. Obviously, 12,000 is a big round number, so look out if we do touch there, because some big longer-term investors might come back in. At the moment, it's you know, here's our 200-day telling us that we're generally in an uptrend, but we're obviously downtrending. You know, it's a larger correction. So no evidence that the correction's ended yet, but a couple of long tails. You know, so maybe this in and around the 12,100 might prove to be it. The way I would sort of typically look at this is this seems to be kind of a pivot area here where we had the peak, two troughs, another little peak here. If we can make some progress above that, you know, then suddenly, you know, it looks like maybe that correction's ended. This is the weekly chart for Brent. Now, it looked pretty soft at this point. Obviously, we took out the lower low, but I did caution at the time that okay, we'd broken through that rising trend line, but we were still basically within a range, and that 45 level ended up holding up pretty well. And we tested the underside of the trend line a couple of times, and so this last week's move to me was significant. Basically tells us we're not in major sell-off mode for oil, we're just in range mode still. I'm not suddenly mega bullish, having been wary of the market here. I'm not suddenly very excited about the oil market. I still think there's a lot of issues, a lot of fundamental issues here, general oversupply in the oil market. And so for that reason, I'd be looking at a continuation of this kind of environment. So it's sudden sell-off, sudden rally, sudden sell-off, sudden rally. So when does the sell-off occur? Wasn't able to down at these levels, down at the 50. We have broken back above 50 quite easily, but maybe the 53.50 was basically where we had the peak here, the peaks there, kind of kept up the base of this range here. And then just as it was kind of like the last vestige here before we sold off quite aggressively. So look out for that 53.50. If we see some reversal candlesticks there, it might be worth a shot. Gold doing well. It's a similar situation where we broke through a declining trend line, but we're easily back through it. We took out the lower, we made a lower low, yet we've now made a higher high too. So again, typical kind of range conditions really. And so from here, it's a little bit, you could look for a Fibonacci retracement of this decline because we did make a lower low, but it's not really particularly classic trending conditions here. So you're really looking for a Fibonacci retracement to catch a bounce within a downtrend. But can you call this a downtrend? Not really. The safer, not safer, but the lower risk trade in a range-bound environment is waiting until you get to the top of the range. So a bit of a wait-and-see environment for gold for me at the moment. The fact that we made it through the 1260 pivot, I think, is positive and suggests that we've got a bit more short-term upside here. When I say the 1260 pivot, I did mention in the video, but there's a series of touches at 1260 along the ray here. And so the fact that we managed to get through it, to me, points to slightly higher prices. So that's about it. We're done and dusted for today. Thank you very much for watching, everybody. Really appreciate you coming. And if you did want to re-watch it, there will be a recording available on YouTube at sometime later today. Otherwise, yeah, thanks again for watching. Jasper signing out. Good luck trading this week.